Richard and Janet are in their late 50s. They live outside Denver. 10 years ago, they sat down one weekend and put $20,000 into 6 different Vanguard ETFs. Same brokerage, same starting amount, same decade. They figured spreading money across 6 funds meant real diversification. Every fund had the Vanguard name on it. What could go wrong? Well, nothing went wrong, but something surprising happened. One of those 6 Vanguard ETFs turned their $20,000 into over $183,000. Another barely made it to $51,000. Same 10 years, same $20,000, but a gap of over $130,000. And here's what gets me. Most people watching this video right now own at least one of these 6 funds, but almost nobody checks which one is actually doing the heavy lifting and which ones are quietly falling behind. By the end of this video, you'll know exactly how all 6 Vanguard ETFs performed over the last decade. You'll see which one hit that 22% average return, and more importantly, you'll know which of these funds are actually worth buying in 2026, and which ones you might be wasting money on. And the part most people miss? 4 of these 6 funds hold almost the same stocks. That means most people think they're diversified, when they're really not. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. So, let's run the numbers. The real 2026 scorecard. All right, 6 Vanguard ETFs. 10 years of real performance data. Let's see where $20,000 ended up in each one. First, VOO, Vanguard's S&P 500 fund. This is the one most people know. It tracks the 500 biggest U.S. companies. Expense ratio, just 0.03%. Over the last 10 years, VOO returned about 15.5% per year. That turned $20,000 into roughly $85,000. Solid. Next, VTI, Vanguard's total stock market fund. Same expense ratio at 0.03%. This one holds over 3,400 companies, so you get large caps, mid caps, and small caps. 10-year return, about 15% per year. 20,000 became about 81,000, almost identical to VOO. Remember that, it matters later. Now, VGT. This is the one, Vanguard's Information Technology ETF. This is the fund that hit 22% average annual returns. Actually, it did even better. The most recent 10-year number is closer to 25% per year. $20,000 in VGT 10 years ago, over $183,000. But here's what nobody tells you about VGT. In 2022, it dropped nearly 30% in a single year. If you had $183,000 in VGT that year, you watched about $55,000 disappear in 12 months. And back in 2008, VGT fell over 50%. Would you have held through that? Be honest with yourself. There's something else. VGT doesn't hold Amazon. It doesn't hold Alphabet. That's Google. It doesn't hold Meta or Tesla. Most people assume a tech fund owns those companies. VGT doesn't. It only tracks stocks classified as information technology. That's a much narrower bet than most investors realize. Now, VYM, Vanguard's High Dividend Yield Fund. This one's different. It's built for income, not growth. Expense ratio is now 0.04%. It yields about 2.3%. Over 10 years, it returned about 11.9% annually. 20,000 grew to roughly 62,000. Lower returns, but you got paid dividends every single quarter along the way. Next, VXUS, Vanguard's Total International Stock Fund. This covers everything outside the United States. Over 8,000 stocks across developed and emerging markets. Expense ratio, 0.05%. And the 10-year return? About 9.9% per year. 20,000 became roughly 51,000, the lowest of all 6. But here's something interesting. In 2026 alone, VXUS is actually beating VOO year to date. International markets are finally showing up after a decade of trailing, so the worst 10-year performer might be this year's best short-term performer. That's worth paying attention to. And finally, VUG, Vanguard's Growth ETF. This targets fast-growing U.S. companies. Expense ratio, 0.04%. 10-year return, about 17.9% per year. 20,000 became roughly $103,000. Strong, second place behind VGT. So let me line these up from worst to best over 10 years. VXUS, about 51,000. VYM, 62,000. VTI, 81,000. VOO, 85,000. VUG, 103,000. And VGT at the top, 183,000. Same starting amount, same decade, wildly different outcomes. The gap between the best and worst is over $130,000. Now you've seen the numbers, but here's where it gets really interesting, because these 6 Vanguard ETFs are hiding something that most people never check, and it changes everything about how you should use them: the overlap trap. Here's the myth: more funds means more diversification. Here's the truth: if your funds hold the same stocks, all you've done is pay more attention to the same bet. Let me show you what I mean. VOO holds the S&P 500. VTI holds the total US stock market. Sounds different, right? Here's the reality. VOO is 100% contained inside VTI. Every single stock in VOO is also in VTI. The weight overlap between these two funds is somewhere between 82 and 88%, depending on how you measure it. Their correlation is 0.99 out of 1. That means if you own both VOO and VTI, you're not diversified. You basically own the same fund twice. Now look at VGT and VUG. Both are heavily loaded with tech. Nvidia, Apple, Microsoft, Broadcom, they show up in both. VUG adds some names VGT doesn't have, like Amazon, Tesla, and Eli Lilly. But the core overlap is massive. And here's the part that should make you uncomfortable. The top 5 holdings in VOO are the same as the top 5 in VTI, and 4 of those 5 also appear in VGT and VUG. Nvidia alone makes up 18.6% of VGT, 13% of VUG, and about 7.5% of VOO. So if you own all 6 of these funds, you might think you have a diversified portfolio. But in reality, you've made a triple bet on the same 10 companies. That's not a strategy, that's concentration disguised as variety. Before I show you exactly how to fix this, drop a comment right now. How many of these 6 Vanguard ETFs do you currently own? I read every single one, and I'll tell you if I think you're overlapping. So if holding all 6 is a trap, what's the smart move? How many do you actually need? And which ones? That's next.
The smart build. You don't need 6 Vanguard ETFs. You need 2 or 3, chosen on purpose, placed in the right accounts. Here's how I'd think about it, depending on what you need your money to do. If you're focused on growth and you've got a long time horizon, start with one core fund, either VOO or VTI. Not both, they're almost identical. VOO gives you the 500 biggest companies, VTI gives you those same 500 plus 3,400 smaller ones. Pick whichever feels right. Then, if you want a growth tilt, add VGT or VUG as a satellite, not as your core. Cap it at 10 to 20% of your portfolio. VGT has the highest returns, but it's a single sector bet. If tech stumbles, VGT stumbles hard. If you're a retiree focused on income, consider VTI as your base, VYM for dividends, and VXUS for international diversification. VYM pays you about 2.3% in quarterly dividends. That's real cash flow. And VXUS gives you genuine diversification, not the fake kind where all your funds hold the same US stocks. But here's the part most people skip. Where you hold these funds matters as much as which ones you pick. VYM throws off a 2.3% dividend yield. That income counts toward your modified adjusted gross income, and in 2026, if your income crosses $109,000 as a single filer or $218,000 as a married couple, you trigger something called IRMA. That's the income-related monthly adjustment amount for Medicare. Going just $1 over that line can cost you over $1,000 a year in extra Medicare premiums per person. And here's the thing, most people don't see it coming until the bill arrives 2 years later, because IRMA uses a 2-year look back. Your 2026 income determines your 2026 premiums. So if you're near those thresholds, hold VYM inside your IRA where the dividends don't show up on your tax return. Keep your growth funds like VGT or VUG in your taxable account instead. Those pay almost nothing in dividends, so they won't push you over. And for VXUS, there's actually a reason to hold that one in your taxable brokerage too. When you own international stocks in a taxable account, you can claim the foreign tax credit. You can't do that inside an IRA. It's a small edge, but it adds up over decades. Now, one more thing to think about. We're in a different market than we were a decade ago. The S&P 500 is sitting at record highs. Inflation just came in at 4.2% for the 12-month through May 2026, the highest reading since April 2023. Rate cuts that everyone expected? The futures market says don't count on a single one this year. And the Shiller-Cape ratio, that's a long-term valuation measure, is sitting above 40. That's near dot-com era territory. None of that means you shouldn't invest. It means this might not be the decade to bet your entire portfolio on the highest returning fund from the last decade. VGT's 25% run was powered by an AI and semiconductor boom at lower starting valuations. Expecting that to repeat from here is hoping, not planning. Let's come back to Richard and Janet. After seeing this comparison, they made 3 changes. They kept VOO as their core, they moved VYM into Janet's IRA to keep those dividends away from the IRMA threshold, and they put VXUS in their taxable brokerage to capture the foreign tax credit. 3 funds, real diversification, tax-smart placement, same Vanguard quality without the overlap trap. Here's the line I want you to remember. Diversification isn't how many funds you own, it's how little they overlap. If someone you know is about to buy Vanguard ETFs without checking this, send them this video right now. It could save them from an overlap mistake they'd never notice on their own. Now I want to hear from you. Which 2 or 3 of these 6 Vanguard ETFs would you pick for your own portfolio? Tell me in the comments. I'll give you my honest take. And if you're building income from your investments and want to stay ahead of changes like this, subscribe to this channel. I break this down every single week so you don't have to guess. Next time, I'm going to show you exactly how to build a complete 3 ETF retirement portfolio from scratch, step by step, with the exact dollar amounts. You won't want to miss that one.